Well, did you ever sit at your kitchen table, coffee in hand, watching a retirement video and quietly think, is this even meant for someone like me? Maybe the host says, just follow a simple 4% rule and you will be fine. And you pause because maybe you have 250,000 saved, or maybe you have 5 million. And somehow you are both being handed the exact same advice. Does that make sense to you? Here is the uncomfortable truth. That is where people lose money, not because they are careless, not because they are reckless, but because they are following the wrong strategy for their level of retirement wealth. And most seniors never see it coming. Here's the truth. If you have modest savings, the danger is running out too soon. If you have significant savings, the danger is silent overpayment, unnecessary taxes, higher Medicare premiums, or one poorly timed withdrawal that quietly costs thousands. Different levels, different risks. This is where it gets serious. Retirement advice is never one size fits all. It is level specific. And if you follow the wrong playbook, you may not see the damage until years later when fixing it is harder and far more expensive. Stay with me. In the next few minutes, I will walk you through the 6 real levels of retirement wealth and help you identify exactly where you fall. At the end, I will give you a clear checklist you can pause and screenshot, plus the key institutions you should verify with so you are not guessing. And before we finish, I will explain the single most overlooked mistake that quietly increases taxes and Medicare costs for thousands of careful retirees every single year. Most people never see it. You will. Now quickly, take 1 second to like and subscribe so this reaches other seniors who need straightforward guidance. And remember, this video is for educational purposes only. I am not a lawyer, and laws vary by state. My goal is to explain this calmly so you can make informed decisions. Because here is what most people miss. Medical bills, taxes, market drops, long-term care, they do not care whether you call yourself middle class or wealthy. They respond to cash flow, tax structure, healthcare timing, and legal preparation. Today, we are going to break this down clearly so you can avoid an expensive mistake with one calm, informed decision. Level 1 is financially vulnerable. This usually means your savings outside your home are modest, and your monthly plan depends heavily on Social Security. Clear statement, the priority here is not optimization, it is survival with dignity. Real life example, imagine Barbara, age 67, living on Social Security and a small savings account. And then the water heater fails and the dentist says she needs work done. She feels cornered and embarrassed, and that is when high pressure offers sound tempting. The risk is not that you are broke, the risk is that one surprise bill makes you act fast. Now listen carefully. If you are here, focus on 3 moves: maximize stable income, reduce essential costs, and lock in legal basics. Social Security timing can matter. Delaying can increase your monthly amount up to age 70, but the right answer depends on health and bills. Medicare enrollment matters, and if income is limited, you may qualify for help programs that many people miss. Pause for a moment. Do not assume you are not eligible. Verify. Also, have a basic will, a healthcare directive, and a durable power of attorney, because the cheapest plan is the plan you do before you are in a hospital bed. Level 2 is stable but tight. Your bills are covered, but there is not much margin. Clear statement, at this level, every dollar needs a job. Real life example, Frank and Linda are retired. The mortgage is mostly paid, they have a pension option, and they choose the bigger check without reading the survivor rules. Frank dies first, and Linda loses the pension income that paid the utilities. A bigger check today can become a smaller life tomorrow. This is the part nobody talks about. Pension elections, Social Security taxation, and Medicare premiums can interact. If you take too much from a traditional retirement account in a single year, you may push more of your Social Security into taxable territory, and you may trigger higher Medicare premiums later. Most people never notice this because the bill shows up after the fact. Also, if most of your wealth is in the house, you can be house rich and cash poor. That is not a moral failure. It is a planning problem. Think about a realistic emergency fund and how you would access home equity without panic. Level 3 is the comfortable middle. Often this is where you have meaningful retirement accounts and a paid off or nearly paid off home. Clear statement, the priority becomes an income plan, not just an investment plan. Real life example, Denise has about $1 million in retirement accounts, but she still spends like she is afraid to touch it, and she skips a family trip she dreamed about. She feels safe but small, like retirement became a waiting room. Money is a tool, not a trophy. Here is where it gets crazy. Many retirees underspend because they never built a spending rhythm. You need an income floor, Social Security, pension, annuity if appropriate, then a flexible layer from investments. And you must model long-term care risk. This level is the danger zone for care costs. You can have too much to qualify for Medicaid easily, but not enough to pay for years of care without stress. That does not mean you must buy insurance. It means you must plan intentionally and you must understand your state rules before a crisis. Level 4 is upper middle. Clear statement, complexity is where expensive mistakes hide. Real life example, Carl retires at 64, delays Social Security, and starts taking random withdrawals for home repairs, grandkids, and a new car. He accidentally stacks taxable income, and later he is shocked when his Medicare costs jump. Accidental income is the most expensive income. Watch out for this. Required minimum distributions can begin when you reach the required age, and those withdrawals can push income higher than you expect. As of current federal rules, many people must begin required minimum distributions at age 73, with a one-time option to delay the first one to the next April. But that can create 2 taxable withdrawals in 1 year if you are not careful. Also, Medicare Part B has a standard premium set annually, and for 2026, it is about $202.90 per month, with an annual deductible of about $283, and higher income can trigger surcharges. Do not let them fool you. The surcharge thresholds feel like cliffs, not gentle slopes, so one extra transaction can cost more than you expect. Coordination is the name of the game. Social Security timing, IRA withdrawals, Roth strategy, capital gains, charitable giving, all of it. Level 5 is affluent. Clear statement, the biggest risk shifts from running out of money to overpaying taxes and mishandling legacy. Real life example, Patricia has significant assets, but most of it is concentrated in one stock from her old employer. She feels proud, but also trapped because selling triggers taxes and she worries the stock could drop. Concentration can build wealth, but diversification preserves it. At this level, advanced tax planning can have a real return, but it must be coordinated with Medicare premium impacts and with your estate plan. Qualified charitable distributions, charitable bunching, thoughtful Roth conversions, and timing of gains can matter. And your estate plan cannot be a dusty binder. Beneficiary designations must match your intent, especially for retirement accounts. Level 6 is ultra-high wealth. Clear statement, the conversation becomes about control, transfer, and preventing family conflict. Real-life example, a couple has more than enough, but the adult children are already arguing about who will handle finances when mom declines. Wealth becomes a stress multiplier. Governance beats performance. For many families, the most important document is not an investment statement. It is a clear plan for decision-making, trustees, powers of attorney, and communication. Estate tax exposure may also be relevant. For 2026, the federal estate and gift exclusion amount is 15 million per person under current inflation-adjusted figures, but state-level estate taxes can be lower depending on where you live, so you must check your state. Most people never notice this until the estate is stuck in paperwork. Now, let me give you the honest truth. Your level does not determine how smart your plan is. Your habits do. Ask yourself, do I have a real income plan? Do I understand which accounts create taxable income? Do I have a care plan? Do I have updated documents? Do I know who will speak for me if I cannot? If any of those answers feel fuzzy, that is not failure. That is a signal. Pause the screen and screenshot this checklist, then replay it slowly and write your answers in the margins. First, identify your level by the role your savings plays, not by pride. Are you mostly dependent on Social Security? Are you stable but tight? Are you comfortable? Are you complex? Are you optimizing? Are you focused on legacy and governance? Second, write your income floor, Social Security, pension, and any guaranteed income. Third, list your tax-sensitive triggers, traditional retirement withdrawals, capital gains sales, Roth conversions, business income, and large one-time transactions. Fourth, write your healthcare risk plan, Medicare enrollment dates, supplement or advantage review, and your long-term care plan, family support, insurance, or self-funding. Fifth, confirm your legal basics, will, healthcare directive, durable power of attorney, and beneficiary designations. Sixth, I created a one-page contact sheet of institutions to verify information: Social Security Administration, Medicare and Centers for Medicare and Medicaid Services, your state health insurance assistance program, the Internal Revenue Service, the Consumer Financial Protection Bureau, and FINRA for broker verification, plus your state bar referral service for an elder law attorney consult. And last but not least, schedule one calm review day per year, not during tax week, not during a medical crisis, one calm day. If this helped, please like and subscribe, because it tells the system to show this to more seniors who are quietly trying to do the right thing. And let me ask you a question. Which level do you think you are in, and what is the one risk you worry about most? Running out of money, taxes, long-term care, or family confusion? Put it in the comments, because I read them personally, and your question helped shape the next video. Our rights do not expire with age.